In August 1995, a company called Netscape went public. At the time, they made a web browser. They had no profits. In fact, they were losing money rapidly. But on the day of their IPO, their stock price nearly doubled in hours. It was the big bang of the dot-com era.
AI. China's latest AI breakthrough.
Artificial intelligence will lead to a reduction of its corporate workforce. AI bubble.
To understand where we are today with artificial intelligence, we have to go back to that moment.
We installed the internet on our computer just a short time ago, and I haven't been able to get the kids off it ever since.
Not only do they play the typical computer games that all the kids enjoy, but their curiosity for learning has skyrocketed.
The mid-90s weren't just about technology, they were about a narrative. The narrative was that the internet would change every facet of human existence. And the narrative was right, but there's a difference between a technology being transformative and a stock being a good investment. Between 1995 and 2000, the Nasdaq Composite Index rose by over 500%. Investors stopped looking at the price-to-earnings ratio and started looking at the eyeballs. The number of people visiting a site, regardless of whether those people ever spent $1. If you added .com to your company's name, your valuation tripled overnight. It was a period of irrational exuberance, where the fear of missing out outweighed the fear of losing everything.
Apple's up more than 6% right now, Google about 3%, but Dell, Intel, Research Motion, and Microsoft are all to the upside. Look how strong.
Did not disappoint. 400 points higher. Yes, indeed. The markets roar higher last 30 minutes of trading as volatility once again rules the day.
Bubbles don't pop because the technology fails. They pop because the math stops working. By the year 2000, the burn rate became the only metric that mattered. Companies like Pets.com were spending $300 on advertising to acquire a customer who would only spend $20 on dog food. The burst began in March 2000. It wasn't one single event, but a realization. High interest rates began to squeeze capital. Major players like Dell and Cisco started placing massive sell orders. Suddenly, the venture capital that had been keeping these zombie startups alive dried up.
We're down 1.7% here, a loss of 37 points or so. Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
By the time the dust settled in 2002, the Nasdaq had lost 78% of its value. $5 trillion in market wealth evaporated. High-profile companies vanished, and for a few years, the internet was treated like a dirty word in investment circles. The impact was more than just red numbers on a screen. It led to a total restructuring of the tech industry. We saw the rise of the Sarbanes-Oxley Act, which changed how companies had to report their finances to prevent fraud. But there's a silver lining that people often forget. The infrastructure remained. Thousands of miles of fiber optic cable had been laid during the boom. When the bubble burst, that capacity became incredibly cheap. This excess actually paved the way for the next generation of giants. Without the failed investments of 90s, we wouldn't have had the bandwidth for YouTube, Netflix or Facebook. The bubble provided the hardware, the survivors provided the value. Fast forward to today, we are seeing a pattern that feels eerily similar. Just as Netscape sparked in the 90s, the release of ChatGPT in late 2022 sparked the AI gold rush. The parallels are staggering. Once again, we have growth over profits. Once again, we have valuations based on potential rather than the current revenue. Sequoia Capital recently highlighted what they call the $600 billion question. This is the gap between the money being spent on AI infrastructure, the chips, the data centers, the electricity, and the actual revenue being generated by the AI software. Nvidia, once a niche company for gamers, surpassed a $3 trillion valuation, at times becoming the most valuable company on earth. Why? Because they sell the picks and shovels for the gold mine. But the question remains, is there actually any gold in the mine, or are we just really good at selling shovels? This brings us to the most controversial part of the current AI boom, the circular economy. In a traditional economy, company A sells a product to a customer, and the customer pays with their own money. In the AI economy, the money is moving in a loop. Think about the relationship between Microsoft, Nvidia, and OpenAI. Microsoft invests billions into OpenAI. OpenAI then uses a massive chunk of that money to pay Microsoft for Azure cloud credits. Microsoft then takes its revenues and uses it to buy hundreds and thousands of H100 chips from Nvidia. Nvidia, seeing its profits soar, then invests back into the AI startup that uses Nvidia chips to build models, which they host on Microsoft's cloud. Trillions of dollars in market cap are being built on these interlocking dependencies. If OpenAI struggles to find a billion-dollar use case, Microsoft's cloud revenue takes a hit. If Microsoft stops buying chips, Nvidia's valuation collapses. The system is perfectly designed as long as the music doesn't stop.
How can a company with 13 billion in revenues make 1.4 trillion of spend commitments?
The core issue is the revenue gap. According to analysts at Goldman Sachs and Sequoia, the tech industry is on track to spend hundreds of billions of dollars per year on AI capex. To justify the spend, AI needs to generate an equivalent amount in new revenue or saved costs. Currently, we see a lot of demos and cool tools, but we haven't seen the killer app that justifies a $600 billion annual bill. Most companies are using AI for coding assistants or customer service chatbots. Those are valuable, yes, but are they trillions of dollars of market cap valuable? That's a big question. We are also facing physical limits. Data centers now require gigawatt scale power, literally the energy consumption of small countries. If the return on investment doesn't show up in the next 24 months, investors who have been patient will start demanding results. And as we saw in 2000, once the sentiment shifts, it shifts fast. So, are we in a bubble? The answer is likely yes, but with a caveat. Like the dot-com era, the technology is real. AI will change the world. It will transform medicine, engineering, and education, and is still doing it. But just because the technology is revolutionary doesn't mean the current stock prices are rational. We are likely headed for a great reset, a moment where the companies with no clear path to profitability will vanish. Just like Pets.com, the circular economy will be tested, and only the companies providing tangible, irreplaceable value will survive. The $600 billion has been spent. The infrastructure is being built. Whether it leads to a new era of human prosperity or the largest market crash in history depends on one thing. Can AI move beyond the hype and start paying its own bills? Because in the end, the math always wins.